Welcome to the Explainer. All right, let's cut right through the noise. Forget the daily chatter about the next hot AI application. Today, we're zooming way out to look at the entire AI revolution for what it really is. And that is a multi-trillion-dollar, multi-decade capital allocation story. This isn't about software, it's about physics. It's about hard physical constraints and this relentless migration of bottlenecks across the entire global supply chain. Seriously, this is a story of steel, of copper, of power grids, of land rights, the real, tangible world that actually underpins our digital one. What we're doing today is laying out a strategic map, a full macro thesis that spans from 2020 all the way out to 2035. And it's designed to show you how to follow the money by, well, following the scarcity. This is the playbook for understanding where profit pools are going to form, and more importantly, why.
So here's the roadmap for our journey today. First up, we're going to establish our core thesis, the big idea we call the Great Bottleneck Migration. Then we'll trace this migration through the past, the present, and the future phases of the AI supercycle, so you can see this thesis in action. After that, we're going to apply the whole framework to a specific deep dive on India's strategic opportunity. From there, we'll get practical and translate all this theory into a disciplined, actionable allocation model. And finally, we'll wrap up by arming you with the key risks and takeaways. The goal is to give you a complete end-to-end framework for navigating this incredible landscape.
Okay, let's start with the intellectual engine that drives our entire analysis, the Great Bottleneck Migration. The core insight here is actually pretty simple, but it is incredibly profound. In a complex industrial build-out like AI, profit doesn't just flow to the company with the loudest narrative or the best marketing. No, it pools with immense force at the point of greatest physical scarcity. The players who manage to control these choke points, they basically gain a temporary monopoly. And that allows them to capture the vast majority of the value created by the entire system. That is, until the system adapts, the capital flows in, solves the problem, and the bottleneck just moves somewhere else.
To really get this, you have to start seeing the AI build-out as what we're calling a serial bottleneck economy. Honestly, the best way to think about it is like a giant global game of whack-a-mole, but with pricing power. In this system, whoever controls the one binding constraint, the single choke point that's limiting the output of the entire system, they gain incredible pricing power. They get to dictate terms, they capture these outsized profits, and they attract this absolute flood of capital. But here's the most critical part. As soon as that capital solves one bottleneck, the constraint doesn't just vanish. It simply migrates to the next weakest link in the chain. And that pricing power, it moves right along with it. Our job as strategic investors is to figure out where it's going next.
So how do we analyze this migration? We're going to use a simple but really powerful mental model over and over again. It's all about thinking in first, second, and third order effects. Now, first order thinking is the easy part. What is the most obvious bottleneck right now, and who owns it? Think NVIDIA and its GPUs in 2023. Simple. But second order thinking goes deeper. It asks, because of that NVIDIA bottleneck, who is now being forced to spend massive amounts of capital? Well, that would be the hyperscalers. Microsoft, Google, Amazon, who are now spending tens upon tens of billions. Who gets policy support? That would be the semiconductor equipment makers benefiting from things like the CHIPS Act. Then you get to third-order thinking. This is about the disruptive consequences. As the entire system reorganizes around this new constraint, what old technologies or business models just plain become obsolete? For instance, the insane demand for power to train AI models might make certain older data center designs completely unviable.
Now, we're not just looking for any old bottleneck. We're hunting for convexity. We're putting on the lens of a legendary investor, Stanley Druckenmiller. And this means we're looking for very specific situations where demand for a critical component just suddenly explodes, but its supply is physically inelastic. It simply cannot be ramped up quickly. That right there, that's the magic moment. In those situations where the marginal costs are low, every single incremental price increase drops almost entirely to the bottom line. That's what creates explosive operating leverage. Think about it. If your costs are basically fixed and this insane demand allows you to raise prices by, say, 20%, your operating profit might jump by 100% or even more. That is the financial signature of a true, high-return bottleneck opportunity.
And finally, we have to overlay all of this with a big cycle lens, kind of like how Ray Dalio looks at the world. You see, this AI arms race isn't happening in a vacuum. It's unfolding in a world with high debt, with volatile inflation, and, this is crucial, escalating geopolitical fragmentation. This macro backdrop is what explains why nations are now willing to re-engineer entire supply chains for national security, even if it's way more expensive. Friendshoring isn't just a buzzword, it's a powerful capital-directing force. It's backed by trillions in government incentives like the CHIPS Act, and it is fundamentally reshaping where the factories, the grids, and the data centers of the future are actually going to be built.
Okay, so let's put this framework to the test. To prove that this isn't just some abstract theory, we are going to track the bottleneck's migration through 3 distinct phases. We'll start with the recent past, which really establishes the pattern. Then we'll look at the present, which defines our current opportunity set. And finally, we'll take a probabilistic look into the future to see where the profits are most likely to flow next. If you just look at the recent past, the pattern is absolutely undeniable. From 2020 to 2022, remember the work from home boom? That created a massive bottleneck in general-purpose CPUs and logic chips. And who were the winners? The foundries, like TSMC, and the equipment makers like ASML, who controlled that scarce manufacturing capacity. Then, from 2023 onward, the bottleneck migrated decisively to accelerated compute for AI. The prime beneficiary there was, of course, NVIDIA, who basically controlled the entire GPU platform. But the story didn't end there. The sheer power of these new GPUs created a brand new constraint, the memory wall. You suddenly needed much faster memory just to feed the chips. This led to a huge rebound for memory makers like Micron and SK Hynix. And soon, even standard memory wasn't good enough. This created a specific shortage of high bandwidth memory, or HBM, where an early leader, SK Hynix, just captured immense value. And even then, even with the chip and the memory, you still couldn't ship a final product without something called advanced packaging, specifically TSMC's CoWoS technology. It became the ultimate choke point, with TSMC's own management openly saying they simply could not meet demand. You see the pattern? At each step, the pricing power migrated to the owner of the next binding constraint.
And that brings us to today. Right now, the bottleneck is making its most dramatic migration yet. It's moving from the microscopic world of silicon to the macroscopic world of physical infrastructure. The constraint is no longer just fabricating the chips, it's finding the raw power to energize them and the cooling to house them in these massive data centers. And this slide illustrates the crucial distinction perfectly. On the right, you have the temporary shortages. We can call them the hairs. Companies are pouring billions into things like advanced packaging and HBM, and capacity is ramping up. These are basically engineering problems that money can solve relatively quickly. But on the left, you have the structural constraints, the tortoises. These are the slow-to-fix, politically messy problems, multi-year queues just to connect to the power grid, shortages of 100-ton transformers that have 2-year lead times, and the immense political challenge of permitting new transmission lines. The key metric is no longer time to chip, it's become time to energized megawatt.
And the evidence for this shift? It is absolutely overwhelming. First, just look at policy adaptation. When PJM, which is the grid operator for 13 states in the eastern U.S., proposes a bring-your-own-generation framework, that is a formal admission that they cannot keep up with demand from all these new data centers. Second, the forecasts are just screaming scarcity. The EIA is now expecting U.S. electricity demand to hit new records in 2026 and 2027, and they're explicitly saying it's driven by data centers. Third, just watch the deals. Big tech has completely pivoted. They've gone from signing renewable power agreements to making direct deals for natural gas and even seeking out nuclear power. Why? Because they need firm, reliable 24/7 power, and they're willing to abandon their previous green-only pledges to get it. And finally, just think about the scale. A single data center project from Meta is planned to consume nearly 1 gigawatt of power. That's enough to power 750,000 homes. The grid was just never designed for this kind of concentrated load growth.
So as we look to the future, we have to shift from certainty to a more probabilistic framework. Our base case, which we're giving a 30% probability, is that this power and grid theme continues to dominate for years to come. That would benefit equipment suppliers and transmission developers. But we have to be prepared for other scenarios. We assign a 15% chance that the bottleneck shifts to optical interconnects. Those are the high-speed fiber links inside the data centers. See, as chips get faster, the power needed just to shuttle data between them becomes a massive problem. And that could benefit specialists in things like co-packaged optics, or CPO. Another 15% probability goes to advanced packaging remaining a constraint if demand just continues to outstrip TSMC's ability to build capacity. We also have to consider a 15% chance of an AI efficiency breakthrough, where the software gets so good that the demand for raw compute actually starts to slow down. And finally, we have scenarios around miniaturization limits and a big material shock, where shortages in key commodities like copper, where you could think of a proxy like the miner Freeport-McMoRan, ticker FCX, or uranium for nuclear power, with a proxy like Cameco, ticker CCJ, actually become the primary bottleneck.
Okay, now let's pivot a bit. Let's see how this entire global framework, this idea of migrating bottlenecks, geopolitical reshoring, and massive capital rotation is converging on one specific high-growth opportunity. We're going to do a deep dive on India, which we think is uniquely positioned to become a strategic beneficiary of this new world order.
So, as the world's supply chains are being forcefully re-engineered away from a heavy reliance on China, this massive opportunity opens up. This is the whole China plus one thesis. And for India, the strategic window here isn't necessarily about competing with TSMC at the bleeding edge overnight. No, it's about owning the critical strategic layers of the new technology stack. It's about building out the data centers for its billion-plus citizens, modernizing the power grid to support them, developing a domestic defense electronics industry for its own national security, and capturing key nodes of the semiconductor ecosystem, things like assembly, testing, and design, all supported by massive government incentives.
And the numbers here are just staggering. A key driver for India is the absolutely explosive growth in its data center capacity. I mean, it's projected to grow by over 50% by 2027 alone. This chart perfectly illustrates our global thesis, just playing out in real time, right there in one country. This rapid build-out is already creating its own severe localized bottlenecks in things like power availability and water for cooling, especially in major hubs like Mumbai and Chennai, where the grid is already under a ton of strain. So solving these local constraints, that is the immediate investment opportunity, because capital simply must flow there to enable this growth.
And this translates directly into specific, investable themes. For transmission and grid modernization, a key player is the Power Grid Corporation of India. They're the state-owned enterprise responsible for interstate transmission. For new power generation to meet this new demand, you have companies like NTPC. To evacuate renewable energy from remote areas to these data center hubs, you have firms like Adani Energy Solutions. In data center connectivity, a proxy is Tata Communications. Then you have the entire ecosystem that's set to benefit from the government's India Semiconductor Mission 2.0. And finally, you have that materials linkage through industrial companies that have a high copper intensity, because you need all that copper to build out this new infrastructure.
Okay, so theory is useful, but as investors, execution is really what matters. So this next section is designed to be an actionable playbook. It provides a clear, disciplined model for how you can actually construct a portfolio to systematically capitalize on this great bottleneck migration.
The model itself is built in 3 distinct layers. Think of it like a pyramid. The foundation, making up 50 to 60% of the portfolio, is the core structural allocation. This is for the most durable, the most predictable choke points. We're talking primarily about the power and grid beneficiaries, like regulated utilities and grid equipment makers. The next layer, at 15 to 25%, is what we call the convex layer. This is for your higher-risk, asymmetric payoff scenarios. Think smaller technology companies in the optical interconnect space or commodity producers like those copper and uranium miners. Finally, at the top, you have a 15 to 25% allocation to a defensive hedge. This is your anchor to windward, this is cash, long-duration government bonds, or other quality defensives. It's designed to help you survive the inevitable macro volatility and regime shifts.
And this is crucial. This strategic allocation is not static. It's not a set-it-and-forget-it thing. It has to be adjusted tactically based on the prevailing macro environment. So, in a bull case, which would be characterized by high liquidity and accelerating AI demand, you would tilt your portfolio towards the higher beta plays, the hares from our earlier slide. We're talking about advanced packaging beneficiaries like TSMC or the optics ecosystem. In our base case of just moderate growth, you simply overweight the core thesis, the tortoises of power and grid infrastructure. But in a bear case, let's say there's a sudden CapEx air pocket or a policy shock, you would want to aggressively reduce your exposure to the narrative-driven AI plays and rotate into the safety of the regulated, contracted cash flows in your core and defensive sleeves.
Finally, we apply a disciplined technical timing overlay to help improve our entries and our exits. Using a framework like Stan Weinstein's stage analysis, we can identify 2 key phases. Stage 1 is the quiet accumulation period. This is when the initial news cycle has faded, volatility tightens, and the smart money is quietly building a position. Your goal here is to patiently accumulate. Stage 2 is the breakout. This happens on new evidence of pricing power, and your goal here is to pyramid into your winning position, adding to it as the trend confirms itself on heavy volume. We also have to monitor macro liquidity triggers. For example, falling real bond yields or tightening credit spreads, those signal an easier financing environment for these capital-intensive projects, and that can act as a tailwind for Stage 2 advances. On the other hand, a strengthening US dollar, the DXY, can tighten global financial conditions, and that would signal a time for caution.
Now, to demonstrate some real intellectual honesty, any robust thesis has to clearly and publicly define its own risks. You have to know what you're looking for that would tell you that you are wrong. So this section outlines the key uncertainties and the single primary signal that would invalidate our entire framework.
All right, so the 3 biggest uncertainties we're watching are these. First, can AI monetization really sustain this insane pace of capital spending? This is the ROI question, right? Are companies getting enough value to justify spending the next $1 trillion? Second, how fast can grid reform and new technologies actually solve the power problem? And third, a major geopolitical shock, like a crisis in Taiwan, which would obviously reprice the entire global tech stack overnight. However, the primary signal that would invalidate our entire thesis is very, very specific. We would need to see clear evidence that grid connection times are shrinking at the same time that packaging and HBM constraints completely disappear, all without a new bottleneck emerging somewhere else. Essentially, the system would have to return to a state of abundance much faster than the physics of these multi-year build cycles suggest is even possible.
So, let's bring it all home and summarize the entire strategic narrative we've built today. It's a powerful and, I think, very clear causal chain. It begins with the simple idea that physical bottlenecks are what dictate where profit pools form. It follows that the most critical bottleneck today is migrating to energy, specifically power and the grid. This trend is then massively amplified by geopolitics, as energy security and chip security force a very costly reshoring of global supply chains. And the inevitable conclusion of all of that is a historic capital rotation, as trillions of dollars must now flow to solve these new, very real, physical constraints.
And finally, we don't want this to be a one-time analysis. The whole point is for it to be a living framework. So think of this last slide as your quarterly monitoring dashboard. These are the vital signs you need to check. Watch CoWoS and HBM lead times to see if those chip-level bottlenecks are easing up. Track the US grid connection queue data and transformer lead times to gauge just how severe the power constraint is. Monitor the adoption rates of next-generation optics to see if that interconnect bottleneck is starting to emerge. And of course, keep a close eye on macro triggers like real yields and the dollar, because they affect the financing for all these projects. And for country allocation, track India's real progress on grid capex and its semiconductor incentives. This dashboard is your guide. It's your guide to tracking how the great bottleneck is migrating. By understanding where the scarcity lies, you can better understand where the capital and ultimately the opportunity will flow next. Thank you for joining us on The Explainer.